The housing market is at its worst in history, and this could see millions of Americans thrown out into the streets or having to move out of the country to survive. The number of people who failed to pay their mortgage in the early months of this year continues to rise and now sits at the highest level since 2011. It has been predicted that the housing price bubble largely exceeds the stock market bubble, and things are about to get unsustainable pretty soon with gigantic waves of evictions, foreclosures, and bankruptcies that could trigger a chain reaction leading the real estate market to a crisis just as disastrous as the 2008 crash. With the year coming to a close, several U.S. cities will face a storm of evictions, foreclosures, and bankruptcies as the housing crisis becomes too difficult to handle, and it is only a matter of time before it explodes into a full-blown disaster. Welcome to the Savvy Few. Big shout-outs to all of our subscribers who has given us the momentum to keep researching and producing these videos. If you are new here, please like this video and subscribe to the channel to avoid missing future videos. Thank you so much for your support. In May alone, 4.3 million homeowners missed their mortgage payments, up from 2 million at the end of March, according to Black Knight, a mortgage data company. That brings the overall delinquency rate for May to 8%. The rate includes borrowers who have arranged to delay or defer their mortgage payment by entering into a forbearance program with their loan servicer, as well as homeowners who have missed payments without such protection. Those in forbearance are protected from being noted as delinquent in their credit report and are expected to work with their lender to arrange a repayment plan. But it is not likely everyone in forbearance will ultimately be able to pay back what they owe, and banks and housing industry experts are keeping a close eye on the delinquency numbers to ascertain how many people are falling behind, whether they are in forbearance or not. The report shows that serious delinquencies are increasing, up more than 50% over the past 2 months, with 631,000 homeowners now 90 days or more past due. But Black Knight's tracking of mortgage payments on a daily basis shows that already a higher share of payments have been made in June than by this point in May, suggesting the delinquencies may be leveling off. Many homeowners who entered into a forbearance program that allowed them to delay their payment still made their regular payment over the past few months. The research showed, although the share that are still making payments is dropping, in April, just under half of people in forbearance made their regular monthly payment. By the end of May, that number had fallen to a little more than a quarter. By June 15th, only 15% had made their payment. The states with the highest percentage of loans that aren't current are Mississippi, with a delinquency rate of 13%, Louisiana at 12%, followed by New York, New Jersey, and Florida, all at 11%. Persistent layoffs are slowing momentum in the labor market, which bodes poorly for the broader U.S. recovery as millions of out-of-work Americans delay their mortgage and rent payments. More than 6 million households failed to make their rent or mortgage payments in September, according to the Mortgage Bankers Association's Research Institute for Housing America, a sign that the economic fallout from the coronavirus pandemic is weighing on jobless Americans as Congress stalls on relief measures. In the third quarter, the percent of homeowners and renters behind on their payments fell slightly from the prior quarter. Still, the overall amount remains high. Experts caution, over the summer, rent and mortgage payment collections improved as states resumed business reopening and more Americans returned to work. High unemployment, however, continues to place hardships on millions of U.S. households. The unemployment rate fell to 7.9% from 8.4% in August, according to the Labor Department. Overall, the economy is still recouping jobs in outsized fashion after shedding a record 22.1 million in early spring, but the recovery is slowing. In September, 8.5% of renters, or 2.82 million households, missed, delayed, or made reduced payments, while 7.1%, or 3.37 million homeowners, missed their mortgage payments. Renters receiving unemployment benefits rose from 3% in early April to 7% by the end of September. Mortgagers getting jobless aid remained unchanged at 3% during that time span, with tens of millions of Americans out of their jobs and unable to make rent payments for the past several months. This has left landlords struggling to meet up their mortgage payments. A new study by the nonprofit CSS has discovered that this would probably lead to a housing crisis that many Americans may not be able to recuperate from in months. CSS President David Jones explains that although the economic downturn has been the trigger for this current situation, the bubble has been in the making for over a decade. They have been pleading to political leaders to address the approaching crisis without delay, stressing that it's urgent to take immediate measures to stop the bleeding. Big cities, such as New York, are in the middle of the storm. The rate of rental delinquency registered in the state is at an all-time high, and landlords are eagerly waiting for the period of grace known as the forbearance period to solicit the issuance of eviction orders. Since rental payments cannot be discharged, all unpaid rent will continue to accumulate, which would become a huge burden for households to clear off later. This would mean more borrowing or more credit card debts to make for owed rent. However, this also means poorer credit scores and problems getting funding to make up for missed payments. On many occasions, real estate firms entered 2020 leverage to the maximum, demanding for ever higher rents and then borrowing against the value of those income streams. As real estate markets soared in several cities across the state, landlords raised rents, resold their buildings at higher prices, and used their properties' rising values to take out ever larger mortgages. The report describes, if this sounds similar, it is because it has happened before. During the 2008 mortgage, real estate firms started an irrational rush of buying and selling buildings and consistently raising rental prices. Things are not rosier for homeowners, which is still as a result of the economic downturn. Today, there are fewer homes for sale in the U.S. than ever documented in the last 4 decades. When the data for U.S. home sales started to be recorded, this has led to an unprecedented rise in the cost of U.S. homes, making homeownership more expensive than it has ever been. The housing shortage is leading to a housing crisis, and with demand outmatching supply, the effects are not expected to be nice. Millions of Americans are having a hard time paying for basics, such as housing, utility bills, and food, while in cities like Los Angeles, more than half the population is jobless. More than 29 million people have lost their jobs, and another 5 million saw their hours cut. Nearly 4 million homeowners are not making mortgage payments. Meanwhile, a recent analysis showed that in 25 major U.S. cities, over 50% are at risk of facing a housing market bubble. Renters and tenants coping with hardships, combined with a looming correction in home values, could weigh heavily on the housing market. Currently, 3.9 million U.S. homeowners are in forbearance, according to the latest estimates from the Mortgage Bankers Association. Forbearance programs generally imply that homeowners can suspend mortgage payments for a time and then repay the outstanding balance in a lump sum when they resume their normal bill cycle. Deferment programs typically allow homeowners to push payment of any missed payments to the end of the mortgage period. These programs would help homeowners stall on payments and build up their credit to enable them to get back in the good books of their lenders. But with the economy still in hardship, and with no hope for the reintroduction of new jobs in the labor market, and with the continuous fall of businesses, small and large, it seems that these programs are only delaying the inevitable. Till our next video, please stay savvy.